Hi, and welcome to today's event where we have the pleasure to present Penneo. To help us through today's presentation, we are fully covered by the company CEO Christian Stendevad and CFO Kasper Christensen. Today's event will cover the Q3 report, fresh from the press this morning. Some headline I got in my eyes. You kept the guidance that you downgraded earlier on, but still it needs to be a busy Q4. And also what we are seeing from the sector, it seems there's a little bit postponement from customers in general, but nothing that we haven't seen from a lot of guys in your sector. As always, you are able to ask questions in the box down below. Do it in Danish, do it in English, Swedish, German. I will try and translate to the best of my ability, but we will keep this presentation in English, and we will have the question and answer at the end of the presentation. But for now, Christian, I think I will hand the call over to you.
Thank you very much, and welcome to all participants on this call. We will now present the Q3, but before, we will just have a very short introduction to Penneo if there are any newcomers to this call. And then I will comment on some of the key features and then hand over to some of the detailed numbers to Kasper, and then the outlook at the end. So the very short introduction to Penneo. We are a business-to-business software as a service company with more than 2,500 customers. And we have a focus on digital signing and all the document workflows around that, and then know your customer. That is part of the anti-money laundering regulation. And we have customers in Denmark, Sweden, and Norway, and Finland, Belgium, and Germany. And we have an aim of becoming the preferred platform for auditors and accounting across Europe. So that's really our go-to market strategy, is grow through auditors and accounting. And then looking into the Q3 result, as if you have seen already our report, you will see that we have now enhanced the reporting with some more key figures. Here on this presentation, I have selected 4 to put some focus on that. But in the report itself, we have enhanced it with the actual result for Q3, then the year to date for this year, and then year on year. And we also put in Penneo in brief. So we have tried in our reporting to put all the key numbers up front. But looking into the key features here, then the ARR amounted to 65 million at the end of Q3 this year, and that's compared to 50.2 million kroner at the end of 2001 Q3. So that represents a 29 year-on-year growth. Our year on year, if you take behind these numbers, if you then look at the Q3 number itself, then the Q3 2022 was 1.5 compared to 2.6 in 2021. If we then take the year on year net retention, then that amounted to 112. And then constitute of a churn rate of 3%. So still at the low end, we have this norm that if we are below 5%, we believe we are doing fine. And then a year-on-year uplift amount to 15%. And then the ARR from foreign markets is 18.7 at the end of Q3 compared to 13.2 at the end of Q3 last year. So 42 year-on-year growth. And then the EBITDA amount to negative 14.3 compared to negative 13.5 last year. So at a similar level. If I then comment on it, so Q3 as a quarter in general, and that was also last year, but also this year, is our low quarter in general. And Q3 this year is then low also compared to earlier quarter by itself. So then so even though you can say that the churn and other things have been fine, then from the level it is at the low end. And we came out earlier this year in mid-October and came out with an announcement of updated guidance where we adjusted the guidance. We also gave some reasoning there, and I'm just going to repeat because it's basically the foundation of the result is that what we see in general from the market is a more cautious buying behavior. So what we have seen here in Q3 is that when customers come to us as new customers, looking at the number, we got 78 in new customers in Q3 compared to 87 in Q3 last year. So it's a little bit lower, but approximately on the same level. But the average deal size is lower. So when we get new customer in, then the commitment that they upfront to the volume is simply lower. So they're more cautious about that the buying behavior, and that is compared to when we had in last year 21. That was around COVID in the first half, and then later on also into Q3 we saw that effect that we now, when we compare things, they started up a year ago with a much higher commitment than we see now. So last year there was a positively impacted, and then what we see now is the negatively impacted by this in general, the market with this more cautiousness. That also has an influence on our uplift in general. So we still grow, as we can see here on the number, so there is an uplift, so meaning existing customers are engaging more with our product and buy more from us, but with a less growth than we have seen earlier. And it's a little bit to the same. And then a third part that we have been focusing on all year this year is a high focus on getting new KYC customers on board. It's by upselling KYC to our existing base and also chasing new customers on it. And for that we are getting new customers on board, also on KYC, but we were chasing large customer deals, and we took that on purpose, that choice, even though that is a more binary, these large deals, and we can see that these has also been postponed to next year. And that was the reason why we here in October made an adjustment to the guidance that I'll come back to, but we are lower in a lower end, and here we can see also based on the numbers how that is reflected in the number. So that is, you can say, from a numbering point of view, how we look at it. Then if we then take also, but what from a business point of view and some business highlights. So what are we doing in this? In general, we have a continued growth in foreign market, and that is our clear focus. We grow in Denmark, but what we would like to do is grow even more outside of Denmark in the foreign markets. And we saw the number just before with 42% year-on-year growth. And if you look into the report, we can see that the growth outside of Denmark is higher than in Denmark. And that is a clear business focus that we had. We announced in H1 report that we here in the spring had hired a local sales manager in Belgium, and now we have created a team around with additional resources in Belgium to pursue that market, and we can see that has a good effect on the both number of leads, opportunity, and also intake. So that is what we have seen there. We in beginning of the year we raised the growth capital, and what we are continuing also here in Q3 is investment in this based on this growth capital in our growth strategy. And one of the milestones that we reach is our 100 employees milestone that we reach here also in Q3, and that continues also into Q4. So we continue that by hiring more people both in sales and also in product. Then we also had continued with our sales transformation, and that we named in H2, and in the report you will see that we explain a bit more what we mean by sales transformation, and that is that we are both specializing our sales force in both KYC and sign. So we knew from the start, before we have raised growth capital, it was the same people that had to do the same. But now we can also, with our effort and growth, we can now specialize in both KYC and sign. That's one of the things we have done. What we have also done is we have hired a team that are proactively reaching out, so an outbound team or sales development team that we have added on top of our inbound. When we looked back when we originally raised money in 2020, there was a high focus on creating an inbound lead machine with marketing, and that also continue now. But now we, on top of that, also have an outbound sales development team that we put even more focus on. So by that specialized, and that we have put in place, and that is part of that plan that we do, and that is also how we also going forward. Even though we see now that the market is more cautious, then it is really to reach out and find those that are willing to invest right now, because in general we believe that the market is there, and that's what we experience also by dialogues with our customers. They might postpone, but there's still a need both for our sign and our KYC. And that is not only in our domestic market only, but also outside. What we are also, some of the highlights that have happened here since our last report is that we have extended our agreement with Data, and below Data is basically our eight banks, which some of them are Jyske Bank and Sydbank. And a year ago we closed a deal with them, and then they started deploying it, and now they have extended that agreement to their private customers. So that's a substantial increase of that agreement, and that's one of the examples also of uplift. We start maybe small in our agreement, and then we have uplift from there. So we are very happy that with that extension that we have done together with them. It also came out in an announcement. And then what we also did in our H1, we opened up and we told about our European Commission trust list project on how to become on that list that only very few vendors are. And in order to be able to deliver qualified electronic signatures, there are 3 levels of signatures: simple, advanced, and then the qualified, which is the highest level of quality of electronic signature, which is something that helps us with our European expansion. And what we have now done, we've done all the auditing, and now we have handed into the authorities and then get it approved. So that's the last step of it that we expect to get approved, so we become on it here before end of the year. So according to also the plan that we released earlier, and that helps us in our European expansion going forward, especially when we go south of the border. Here in the Nordics, a tradition of the advanced signature is enough, but going south, then in other countries, then the qualified electronic signature gives us an advantage. So these are the things that we have worked hard on, and also how with that we invest into also the future growth. So with this, I would hand over now to you, Kasper, to go into some of the numbers.
So now we can start on the interesting part of this slide deck. Cool. The first chart I have chosen to present for you guys is our cohort analysis. And this chart shows that we divide all our customers up in the year they become customers, and then we show the annual value for that customers. So here you have an entire history of our portfolio, how has it developed over the year. So for instance, the dark blue column in the bottom here is the customers coming in 14, and here you can see it has developed over time, and that's more or less the story about Penneo, that every cohort is growing year over year, meaning that when some customer is churning, the customers remain customers are growing more than the customer churned. The next slide is our development the past 12 months. As Christian says, we have had a year growth on 29%. And here on the chart, we have divided into how the current customers before Q3 up until Q3 last year, how that has developed during this period, and how much is coming from new biz. And what you can see here is that we are maintaining our low churn. It's on 3%. I also think that Christian told we are proud as long as it's below 5%. Uplift is 15, while we have a net ARR retention rate on 112%. On top of that, we added 18% by getting new customers in. And here you also have the split between Sign, which is our original product, and then the Know Your Customer product, which is our newest product. This chart shows how we growth in terms of domestic market, Denmark, or foreign market, every country outside of Denmark. When I dive into the numbers behind this chart, I can see that more than 40% of our new business in Q3 is coming from countries outside of Denmark. And of course, foreign markets is pretty important for us since we since 20 set out an internationalization of our company. Then it's also important to see that we are having good traction on that part. This is our SaaS numbers. The last 12 months, we have gotten approximately 400 new customers in, average ARR on 22,000, and it cost 32,000 to get those customers in average. And just to highlight that in this slide, you have the 16.5% growth on average the first 5 years, what we can see from our historical performance or cohorts. So you can do your own math about how much is the lifetime value for one customer, so you can compare that amount to the 32Ks. As you can see, and what Christian also told, in Q3, the average ARR per new customers is for 15,000, and it's a pretty low numbers for us. But even the fact that this is a low numbers, since we have a net retention rate on 112%, we managed to increase our average revenue per account since we have a huge portfolio. So the 78 new customers on top of this, even it's below our average, it's not enough to take down the average. And here is our P&L. What you can see here is that our revenue increased by 30%, and our contribution margin is the same as last year, and last year was more or less the same as the year before. So normally, if for some quarters it's going 1 percentage point up or down, what we normally say is that as long as it's 80%, we are satisfied with this numbers. What is more interesting here is like the staff cost. How much have we increased our staff cost during this year since last year? And it's 33%. And this slide shows how much one new Danish ARR crown we get in. How much does that crown cost? And if we and I believe it makes sense to always look on a 12-month period, since we have seasonality. So it's not fair to judge from one quarter to another. Then you will be like very happy or very disappointed. So always look on 12-month period. And what you can see if we take from Q4 last year up until now, Q3, is that for every time we spend 2.1 crown in negative cash flow, we gain 1 Danish crown. So the relationship there is like, it's pretty high when you look into the 2020 and the 21 average here. It's like 1.8 and 1.3, and now we're on 2.1. The reason is that we are a half year into our new investment period. We raised capital in this spring, and now we have had a half year where we start deploying, hiring a lot of new people. As you also said, we reached this 100 milestone. What we actually do is to hire more people than we could afford if we hadn't raised capital. Why now the journey has set out, why it shows that we have deployed a lot of cost, and now we're waiting to see the benefit of that cost. So when we coming, the longer we are in this investment period, you'll see that we start having a better relationship between negative cash flow and the growth. And of course, if you don't raise further money, you cannot invest more than what's coming in. So at the end, it will be at least down to 1, this relationship.
Then going to the outlook for 2022, so meaning the rest of the year. Originally, we had a year-on-year growth rate of set out for 77 to 82, and then here in October we made an adjustment to 70 to 75, corresponding to a year-on-year growth of 27 to 36, and that is kept also in our Q3 report. So we expect to be within this range based on all the knowledge we have now, including also the knowledge of bank data that is now have been coming in. So that is from the guidance point of view. And from the EBITDA, then originally in our report before we raised capital, we had a guidance of -5 to -10. Then we increased the investment of -15 to -20, and we have kept that both in the adjustment and also after the AR adjustment and also in the Q3 report. So we expect to be within this range also. So that ends basically our presentation. Then we are open for all the questions that might
questions.
Let's
start with one of the questions there. Do you see any special reason that the average size of new customers is smaller than usual? I think you touched a little bit upon it, that they don't sign up for such a big package. Any other reasons here? It might connect to some other questions about price competition and such stuff.
Yeah, but it is basically so. Of course there is competition, but that the main thing that we see is that the commitment, so the volume you commit to is smaller. So basically we estimate the volume that is needed together with the customer, and then based on that, then they make a commitment on what they believe, and then they pay upfront for 12 months. And the more you commit to, the more volume discount you basically get. And a better deal. But here, when it's a little bit cautious, then you say, okay, we don't know yet as a customer, or we might know it, but let's just start smaller. It might be a little bit more expensive per unit, but in general, that's what we see, and there's a clear trend that we see among our customers. Then, of course, when they then come to the volume that they do expect later on, then they can always add more, and then they, of course, then it will become as upsell later on. But that's the cautiousness that we see from customers. They are a little more cautious when they make these commitments because of this uncertainty that are in the market, even though they are not directly influenced by it from their profit and loss. Yeah.
And to that question, I might ask, should we then expect, to see if this continues, then you might also be able to raise the 16.5% that you can grow your current customer base on, because I guess if you get a customer in of a certain size, you kind of know that if they are not smaller customers, if it's not price competition, then at some point in time, and if they implement it fully, then they must have grown to a normalized size, meaning that smaller customer ends now will mean maybe a higher growth rate for this the current customer base.
Yeah, that you're right. That is not that we can say from every one of them, but in general, when you commit lower at the beginning, then if you then deploy it as we have seen before, and then the engagement will increase, and then you buy it later on. A little bit like when you do subscription on a phone subscription of data, for example. How much data do you need to have? Then you look at it and see, do you really need it for now? And then you increase it later on. It's the same with us.
No. And perfect. And to that question, I'm thinking, there's a question here about price competition. I guess smaller customers might be a little bit more prone to look at cost very, very fast. You have competition out there. Are you seeing anything by the smaller customers? I guess where you are really integrated in their system, it's probably not the case, but in other cases, are you seeing anything out there in the market?
Not more than usual. So yeah, no. The short answer is, there is competition, but that's not the pressure. It's more the commitment level.
And then the situation you mentioned on the staff turnover. I guess we closed the quarter a couple months ago. Has that improved? In the 1.5 months, are you seeing that the things you are doing to try and make that better is actually working?
Yes, we can see it's completely true, and we also said that in our report that's what we have seen, and also it also went into Q3. Now, one thing is we have got a team on board, fully committed, and the second part is that has also helped us. We are one of the companies that do grow and invest in more people, and then the other companies that do not. So we can now see also how we can attract more people, talented people. Right? So we are now in that advantage situation compared to at least others.
So the 100 you mentioned and looking at it is now developing according to your plans that you put out for growth.
It's already now a higher number than the 100. Yeah. And
then there's a question here. You stated that investment we carried out with precaution. Is also that the case for 23? And what are the deciding factors? When I read your report, you are mentioning that you are precautious, but you're still going ahead with the plans for 23. A little bit elaboration around how to interpret both statements.
Yes, and that's exactly. And often we are asked, okay, but under these circumstances, shouldn't you try to be profitable as soon as possible? And then we believe that it is a good business case in investing in growth based on the numbers that we have also seen. How much the CAC is, the customer acquisition cost up against our average value, and how we can have uplift afterwards. So we believe it's a good idea, but what we still do is we constantly balance the growth rate that we are seeing up against the free cash flow that we are using. So that metric that Kasper went through is a very important one of us, and that we go months after months. We could also just see, but if we, for example, we believe, no, the market will be completely normal in 3 months' time, so we just deploy all the money immediately. That would not be cautious under these circumstances. So we check it, but as we grow, we look at these numbers, then we take all the precautions of evaluating if we are on track. So we will not run out of cash.
And I'm sure you will not answer this, but is there a cutoff there? I know you really track this, and it's a very good number, this cash flow to the ARR. And I do understand that it's not the 1.3 we should compare with, it's the 1.8 where you were also in the growth phase, and it's not that much higher. But is there a cutoff there, where you're seeing maybe we should look a little bit more on profitability versus growth?
Yeah, of course. If that is too high, then we believe then we should not. Then we should slow down a little bit the growth. We will still grow, but it's really at that rate. So that's what we are evaluating. But we are also showing to show some of it as part of the plan. That's the reason why Kasper walked through. So when we are in end of an investment cycle, then we go towards profitability. But because we believe there's a good business case investing in growth, then we do it because we have cash to do it.
And you touched upon it. You said that you had actually be satisfied with 5%, but you have had the churn level at a very low rate. So a low churn level, is that kept despite the market uncertainty? Any insights into 2023? Are you seeing anything? Do you have a feeling that this could be pressured by a worse market?
So basically, that's a forward-looking statement on that sense. We see, so it's a figure that we follow, also very closely. If suddenly customers start leaving us, so we have a churn, as we can see on these 3, 4, 3, 2, and that's a level. And we say below 5. What is very important for us, if it's suddenly, for example, then customers cannot, they cannot afford us anymore because of whatever reason, and then start churning. That will be something that will be critical for us. So what we focus on is to also after sales support and customer success in keeping them getting the value. And there is a high level of stickiness in this. So if they get the value out of it, they stay with us. That's what we have seen so far. So it is a metric that is important for us to follow, but so far we have had on that level, and there's no indication that suddenly it should be completely different.
And a question regarding that, is that why you have focused so much on upselling the KYC, because your stickiness will actually increase by it being a more integrated system?
That is exactly a good comment. Yes, we believe that the more you buy from us and also have it integrated and you're part of it, and with the trust that we provide to the customer, that will also increase the stickiness by itself.
And a question I also see from the sector is actually that some are switching again a little bit more to not only subscription but also a part usage based. You are not switching that. That's not the reason why you're going down to 14,000. But as you mentioned, maybe the customers are a little bit more hesitant to switch to a model and going lower. Are there any thinking about switching a little bit more to a base subscription and a usage model?
No, we are continuing with the model that we have.
You continue at the model. Yeah, perfect. So all new customers coming in right now is subscription based. Is that correctly understood? And the revenue still covers a little bit of the old agreements from early on.
Correct. That's exactly right.
Perfect. Yeah, but I think that was all the questions. Thank you to you, Kasper and Christian, for taking us through, and thank you for the audience for listening in and asking questions. May everybody have a nice day.
Thank you very much.
Thank you.